A stock chart fills a laptop screen. The line moves up, dips sharply, then recovers. A cursor hovers over a recent peak. The date is visible. The price is higher than it was months earlier. Market timing begins with a simple idea. Buy before prices rise and sell before prices fall. The concept appears straightforward when looking backward at a chart. On a historical graph, peaks and troughs are clearly visible. The ideal entry points and exit points appear obvious in hindsight. In real time, those turning points are not labeled. When markets decline 10%, it is unclear whether the decline will deepen or reverse. When markets rise 15%, it is unclear whether the rise will continue or stall. Timing requires two correct decisions: when to exit and when to re-enter. Compounding determines scale. Exposure determines whether compounding can operate at all. Selling during a decline may avoid further losses. Re-entering too late may miss recovery. Re-entering too early may capture additional volatility. Now examine missed days. Pull up a long-term market chart covering 20 years. Remove the 10 best-performing days from that timeline. The overall return drops significantly. Remove the 20 best days. The decline in cumulative return becomes substantial. The strongest market days often occur near periods of high volatility. Missing a small number of them alters long-term results. Now compare continuous participation to partial participation. Investor A remains invested throughout a 20-year period. Investor B exits during downturns and re-enters after conditions appear stable. Investor B avoids some declines but often misses portions of recoveries. Over time, the compounded return may lag despite occasional successful exits. Now consider the psychological difficulty of re-entry. After a 25% decline, news coverage intensifies. Economic uncertainty appears elevated. Re-entering requires committing capital while uncertainty remains visible. Waiting for clarity often means waiting for price recovery. By the time conditions appear stable, markets may have already advanced significantly from their lows. Now examine the effect of short-term forecasting. Quarterly economic forecasts adjust frequently. Interest rate expectations change. Earnings projections update. Markets price these expectations continuously. By the time a forecast becomes consensus, asset prices may already reflect it. Timing assumes that future information can be acted upon before it is priced. Now examine opportunity cost. Capital moved to cash during a downturn earns limited return. If the market recovers quickly, the difference between invested and uninvested capital compounds. Short absences can have long-term consequences. Now compare two sequences. In scenario A, an investor exits after a 15% decline and re-enters after a 10% recovery. In scenario B, the investor remains invested through both movements. Over repeated cycles, small missed recoveries accumulate. Now introduce compounding. Returns compound only while capital is exposed. Periods in cash interrupt the compounding base. Even short interruptions reduce the exponent in the equation. Now examine transaction costs and taxes. Frequent selling may trigger taxable gains in non-retirement accounts. Realized gains reduce reinvestable capital. Trading spreads and costs add friction. Timing adds operational friction that long-term holding does not. Now, compare volatility tolerance. A continuously invested portfolio fluctuates daily. A timing strategy fluctuates between market risk and reinvestment risk. Avoiding volatility entirely requires perfect foresight. Partial avoidance often results in delayed re-entry. Now examine historical recoveries. After major downturns, markets have historically recovered over varying time frames. The strongest recovery days often occur early in the rebound phase. Missing the initial phase can reduce long-term compounding materially. Now, compare intention to execution. Selling at a defined threshold may appear systematic. Re-entry criteria often become discretionary. Systematic exit without systematic re-entry produces drift. Now observe long-term data. Over extended periods, broad equity markets have trended upward despite recessions, crises, and corrections. The majority of long-term return comes from sustained participation rather than tactical shifts. Now consider an investor contributing regularly through automatic transfers. During downturns, contributions purchase more shares at lower prices. During expansions, contributions purchase fewer shares at higher prices. The mechanism operates without prediction. Now, compare that to halting contributions during declines. Stopping contributions during volatility removes the opportunity to accumulate at lower valuations. Timing alters the accumulation pattern. Now examine the visibility of regret. Remaining invested during a decline produces visible losses on a screen. Exiting and watching markets recover produces a different kind of regret. Both outcomes are visible in account history. Now compare total time invested. Investor A remains invested for 20 full years. Investor B spends 4 of those years in cash across various cycles. Even if both experience similar average annual returns while invested, total compounded return differs because total exposure time differs. Compounding depends on exposure duration. Now examine scale. A portfolio that compounds at 7% annually for 30 years grows significantly. Interrupting that compounding periodically reduces scale, even if average return appears similar in shorter windows. The math does not require perfect timing. It rewards sustained exposure. Market timing attempts to optimize entry and exit. Long-term investing attempts to optimize duration. One relies on precision. The other relies on continuity. Charts look clear in hindsight. Real-time decisions do not include future labels. Timing requires predicting not just direction, but turning points. Participation requires remaining present. Over long timelines, the difference between continuous exposure and intermittent exposure becomes visible in final balances. Automatic transfers maintain exposure. Structural discipline maintains allocation. Compounding magnifies time spent invested more reliably than attempts to predict short-term direction. Markets move in waves. Participation determines how much of those waves affect capital. The mechanism is mathematical. Exposure compounds. Absence does not.